Hi, welcome back to another edition of Blipper's Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows basically for the conventional fund business, but later on we'll talk about ETFs as well, for the week ended July 24th, 2013. That's a one-day Wednesday period, as we always do. You know, one of the things that we note is that money flew out of the fund industry, about $6.7 billion, but certainly the number alone doesn't tell the whole story. We really had some pretty good funds and flows into equity funds. But before we get there, let's say how we got there. Really, the good returns that we had during the week were caused by some good news that we saw with new home market. Basically, the new housing sales were on the rise. We saw that we had better than expected earnings from a lot of the reporters, that I think people were expecting some disappointing earnings and earnings forecasts. And then also we saw that there was a decrease in the jobless claims. The new jobless claims came out, and that was very encouraging. In fact, what we saw, the Dow Jones Industrial Average and the S&P 500 hit their 28th and 23rd not consecutive, but 28th and 23rd record high for the year. So that was really kind of an amazing feat. So we really had some good things that were carrying us on. And so we saw some outflows from money market funds. This is how it happened. Let's take a look at our macro group and see where the flows actually occurred. We saw equity funds, as I was telling you about, do pretty well. $3.3 billion were inflows into that group. Taxable bond funds returned to their merry old way, taking in about $3.9 billion. And then we saw muni bond funds take up another black eye. $1.2 billion in outflows, and we got more story to tell you about it there as well. And money market funds saw outflows about $12.7 billion. That's where the lion's share of outflows occurred, and certainly the reason we saw 6.7 exit the industry. Well, let's take a closer look at the equity funds classification to see how the flows occurred. Basically, we saw about a 0.45% return for the week. It's pretty strong, actually. Fourth consecutive week that we've seen positive returns. So again, that was one of the stories that we heard too, is the S&P 500 had fourth consecutive week of positive returns, and certainly that translated through to mutual funds as well. And when we take a look at this, is the 29th consecutive week we saw inflows, $3.3 billion of net new money entering the coffers of equity mutual funds. Year to date, that brings the total of inflows to $115.6 billion. So we had $115.6 billion actually coming into the coffers of equity funds. Now, when we take a look, there was a little bit change of leadership. Domestic equity funds took in about $2.4 billion, seventh consecutive week we've seen inflows. And then when we took a look at the non-domestic equity funds, we saw about a little less than $1 billion in inflows as well. And that's been kind of an unusual story, but it was their eighth consecutive week that we've seen inflows into that group. Now, how this broke out, though, and kind of the unique nature of it, is we saw large cap funds actually take in about $1.3 billion. That was actually a good number. And in contrast, we're going to see kind of an opposite side when we get to the ETFs in just a second. But what we saw was the emerging market funds take in about $300 million of money. So really the storyline has been kind of the same, staying frequent, but again, large cap was kind of the new way to go for a lot of investors as they were looking for where to place that limited amount of money into new assets. Well, let's take a look at equity funds on the ETF side to see what happened there. We saw inflows for the fourth consecutive week, and we saw about $2.1 billion net new money enter their coffers. Here is where the difference is, though. Basically, we saw that financial select sector spider fund taking the biggest amount of money. Makes sense. Rise in interest rates and the like, and basically we're seeing financials do better, right? Because that's how they earn their money. We also saw that the Japanese market was doing pretty well. So we saw the Wisdom Tree Japanese hedge fund equity funds taking about $399 million. And the last piece, we saw the iShare Russell taking about 2,000. So ETF investors were more on the risk scale rather than on the long term. And in fact, here's the dichotomy. We saw at the bottom of the barrel, we saw SPY, the Spider S&P 500, basically lose about $1.3 billion. And again, this is the institutional investor leaving large caps while retail investors were coming into it. iShares MSCI USA, the minimal volatility, U.S. minimal volatility, basically saw about $700 million net new money. And then on the very bottom as well, the third worst loser of money was the PowerShares QQQ. So about $300 million of outflows there as well. Well, now that we've talked a little bit about the equity side, let's take a look at the fixed income arena. On the fixed income arena, we saw basically that we saw the third consecutive week of inflows. It was $3.9 billion net new money coming in there. As a fourth consecutive week, we've seen plus side performance, 0.11%. Not a lot to write home about, but on the plus side nonetheless. Here's the interesting piece. Investors were going after risky assets. So high yield funds took in $2.1 billion. We saw the corporate investment grade debt funds taking about $1.6 billion. And of that subset, we saw loan participation funds taking $1.8 billion. That is a record. First of all, $1.8 billion was the most that they've seen come in since we've been tracking these since it started in 2003. Our database goes back farther. That was the first time that loan pars were around. So weekly flows, again, best weekly flows this week since we started tracking in 2003, and it's the 58th consecutive week that we've seen inflows into loan participation funds. So that's kind of the interesting point that we wanted to make a point on. And the other point is that we saw outflows out of treasuries, mortgage, and treasury and mortgage type of securities. Well, on the ETF side, that certainly plays out to be about the same. If we take a look at the ETFs, basically we saw about $600 million in net new money come into their coffers. Of course, it's a smaller universe. The iShares iBox High Yield Fund took in $726 million in net new money, while Spider Barclay High Yield Fund took in about $252 million of net new money. And as we saw in the open-end traditional conventional mutual fund industry, we saw longer dated treasuries at the bottom and tips at the very bottom. Well, that brings us to our next piece, and that's basically our muni bond funds. Muni bond funds were just a story on their own. We saw about $1.2 billion in outflows. This is the 9th consecutive week that we've seen outflows, and of course, this was on the news that one of the largest cities in the United States declared bankruptcy on Friday, and that was Detroit. Basically, investors have been concerned about higher interest rates. They've been concerned about unfunded and underfunded pension plans and longer liabilities on their spreadsheets, and of course they're just worried about increase in interest rates. For the second consecutive week, actually second week in 3, we saw that they had negative performance, about 1.05. A lot of that has to do with the people finding out about Detroit. And then last, if we take a look at it, the national munis saw about $800 million in outflows. Of course, single state was the remainder. Well, let's take a look now at money market funds. And money market funds, like I said, was the pariah of the group. About $12.7 billion in outflows. It's the first week in 5 that they've seen outflows. And certainly there's not a lot to talk about. I mean, you can't talk about trends. There wasn't any in a quarter period that we were worried about that money was flowing out because of the funding of, let's say, 401ks and IRAs, or even having quarterly funding for tax revenues. This is just one of those areas that people probably just moving money. We know about 2/3 of it went back to work in the fund industry. The other third is off doing whatever it normally does. How the breakdown occurs is we saw taxable money market funds lose about $11.9 billion, and then we saw the institutional side actually take into account for 7.6 of those $11.9 billion, and on the retail side about $4.3 billion in outflows. Tax-exempt money market funds had about $800 million in outflows as well. So that was the story for money market funds. Well, as we go forward, the things that we're going to keep an eye on is certainly going to be earnings. Now, one of the stories that was told just recently was by our brothers at Thomson Reuters Proprietary Research. And basically they came out and said, listen, of the 146 funds or constituents of the S&P 500, 66% of them actually had a profit that was above expectations. So that not only their earnings, their bottom line earnings, but in many cases their top line earnings were better than expected. So this would certainly turn the market on the positive side. And I think a lot of people expected some ho-hum news when it came to the earnings reports, and so that was pretty good. So we're going to keep an eye on that. Obviously, we're going to keep an eye on Detroit as well to see if there's any shake-up or follow-through from that. Certainly, Whitney is out there saying that she sees a whole bunch of other municipalities hitting the dirt and crashing and burning, but we don't know that's going to be true. I mean, certainly that could happen to some of the high yield areas, but not in the AAAs and the AAs and the higher rated muni debt funds. We just don't think that's going to happen. Well, if you want to do a deeper dive and check out the areas that you prefer to find fund flows on, you can go to our website at lipperusfundflows.com. Or you can wait till next week when we have our report. One of our analysts will give you on what the trends and facts are for that week. Until then, my name's Tom Rosine, wishing you the best in your wealth planning and creation.